Imagine you are walking into just this colossal stadium-sized control room.
Oh, yeah, like something out of a sci-fi movie.
Exactly. Screens absolutely everywhere, thousands of operators, and, trillions of dollars flowing in real time. It's basically the nerve center of global capitalism.
Right.
But if you look at the media, like if you watch financial news networks or read your average investing blog, you would think the only thing in that massive room is just a single flashy roulette wheel sitting in the corner.
The stock market.
The stock market. We completely obsess over it.
Hmm.
The Dow, the Nifty, the latest tech IPO. But that massive control room, the actual machinery dictating the cost of capital, the speed of economic growth, the survival of nations.
That is the fixed income market.
Yes. Welcome to another custom deep dive. Today we are opening up a particularly dense, but honestly vital piece of source material.
Oh, it is dense.
It really is. It's Chapter 4 of the NISM Portfolio Management Services, or PMS Distributor Certification Workbook.
Right.
And the mission today is to completely dismantle and, analyze this section called Investing in Fixed Income Securities. And there's this grand irony in the text right from the opening pages.
Which is that everyone talks about equities, but the global bond market completely dwarfs the total market value of all stocks combined.
It's not even close.
Significantly bigger. And what is really fascinating here is the sheer structural complexity of it all. I mean, an equity is relatively straightforward, right?
You buy a share, you own a piece.
Exactly. You buy a share of a company, you own a fractional piece of its future earnings. And whether that goes to the moon or drops to absolute zero, it's pretty simple to grasp. But fixed income, it's a sprawling web of highly specific, legally binding contracts.
Right, because, a single telecommunications giant might have one ticker symbol on the stock exchange, just one flavor of equity.
Stock.
Yeah, but that exact same company could have like 60 different tranches of debt outstanding at the exact same time.
Oh, easily.
Some mature in 2 years, some in 30. Some are backed by their physical cell towers, and others are backed by literally nothing but a promise.
Some pay floating interest rates, some pay fixed. It really is a three-dimensional chessboard.
Which is why a portfolio manager operating in this space needs a fundamentally different toolkit. You aren't just looking at a company's growth prospects.
No. You are analyzing legal indentures, macroeconomic interest rate trajectories, and these highly sensitive mathematical pricing models.
Okay, so let's unpack this. Before we can even begin to value a bond or look at those crazy math models, we need to understand the topography of the Indian fixed income market as laid out in this PMS workbook. Like, who are the actual players demanding all this capital?
Well, if we connect this to the bigger picture, the market is strictly segmented by the legal nature of the borrower. And the absolute heavyweight, the entity that just absorbs the vast majority of capital, is the sovereign.
The government.
The government, yes.
So we are talking about the central and state governments issuing GSECs, right?
Yeah.
Government securities.
Yeah, exactly. When the government needs to fund a massive infrastructure project or, simply bridge the fiscal deficit between their tax revenues and public spending, they issue GSECs.
Right.
And this is the foundation of the entire market because it establishes what we call the risk-free rate.
Because the government can always just print money to pay you back.
Precisely. Every other bond in the country is essentially priced by taking that GSEC rate and adding a specific risk premium on top of it.
Okay, so the government is the anchor. Who sits below them in this hierarchy?
You have public sector undertakings, statutory corporations, and then moving into the private sphere, you have banks and non-banking financial companies, the NBFCs.
Right, and they issue debt just to fund their own lending.
Exactly, massive amounts of it. And then finally you have corporate bodies, private manufacturing, tech, or service companies issuing corporate debt.
Which are commonly referred to as debentures in the Indian market, right?
Right.
If they're long-term instruments.
Yes, exactly.
Now, in the equity world, SEBI, the Securities and Exchange Board of India, is kind of the undisputed sheriff. They regulate the stock exchanges, the brokers, the IPOs, everything.
Everything equity, yes.
Right. But the fixed income market has this very specific, bifurcated regulatory structure.
Yeah, and this is a crucial distinction for anyone operating in the Indian financial sector. The regulatory oversight is actually split based on the systemic impact of the debt.
So how does that split work?
Well, the Reserve Bank of India, the central bank, regulates the money markets and the government securities market.
But why does the RBI take the GSECs and not SEBI? They're securities.
It's because government debt is intimately tied to the nation's monetary policy.
Oh, right. Because of the money supply.
Exactly. The RBI uses the buying and selling of those GSECs to manage the money supply, control inflation, and really dictate the liquidity in the entire banking system.
Mm.
It is a fundamental macroeconomic tool, so the central bank absolutely must control it.
Okay, that makes sense.
The RBI also regulates debt issued by banks and NBFCs, again, because of the massive systemic risk those institutions pose to the broader financial system.
While SEBI takes the corporate side.
Right. Well, to be more precise, SEBI regulates non-government securities.
Okay.
So the corporate debentures issued by private entities fall under SEBI's mandate, and their focus is heavily on disclosure, investor protection, and making sure the corporate debt markets function fairly.
So it's two different regulators with two entirely different primary motives. The RBI is managing systemic liquidity, making sure the economy doesn't crash, and SEBI is managing market integrity and transparency.
Precisely.
But here is where it gets really interesting to me. The text highlights this massive structural quirk about the Indian corporate debt market. It is almost entirely a private placement market.
Yes, dominated by wholesale investors.
Right, and this raises an important question about how capital actually flows. Because when a corporation wants to raise equity, they do an initial public offer, an IPO.
Right, they plaster ads everywhere, they get retail investors to buy lots of 15,000 rupees.
Exactly. But when that exact same corporation wants to raise the 1,000 crores in debt, they don't go to the public.
No, they go behind closed doors.
Right.
They utilize a private placement. They negotiate directly with a really small syndicate of institutional heavyweights. Mutual funds, insurance companies, pension funds, maybe some large commercial banks.
And they sell the entire issue in massive blocks.
Exactly.
Okay, I want to push back on this structure for a second. If the corporate bond market is the engine of corporate growth, why is it structurally walled off from the retail investor?
It's a fair question.
If I have capital to deploy, why can't I just log into my brokerage account and buy a single corporate bond as easily as I buy a share of Tata Motors?
Well, it really comes down to three things: ticket size, credit risk analysis, and secondary market liquidity.
Okay, walk me through those.
First, the denomination of wholesale debt is just prohibitive. A single corporate bond in a private placement might have a face value of 10 lakh rupees, or even a crore.
Wow. So it immediately prices out the average retail participant.
Yeah, it's a significant barrier. You can't just buy a fraction of it. But the second issue is the burden of credit analysis.
Because bonds are riskier than they look.
Well, think about it like this. When you buy a stock, your downside is limited to your investment, but you have infinite upside, right?
Right.
With a bond, your upside is strictly capped at whatever the interest rate is. But your downside is a total loss if the company defaults.
Oh, wow. Yep.
And analyzing the real probability of that default requires tearing apart balance sheets, assessing collateral, stress testing future cash flows. The regulators assume, and perhaps rightly so, that the average retail investor just does not possess the institutional capacity to perform that level of rigorous credit analysis.
So the system basically forces a buffer. It tells you, the retail investor, look, you can't buy the corporate bond directly, but you can give your money to a mutual fund manager or a PMS, and they will buy the wholesale block and manage that crazy credit risk for you.
That is the intended architecture, yes.
Yeah.
And it leads directly to the third factor, which is liquidity.
Right, because it's a private placement.
Because these institutional giants are buying massive blocks of debt, they usually intend to hold them all the way to maturity. Think about a life insurance company.
Okay.
They buy a 20-year bond because they know they have to pay out policies in 20 years. They are perfectly matching their assets to their future liabilities.
Which means they aren't day trading them.
Right. They lock them away in a vault. Consequently, the secondary market for corporate debt in India is notoriously illiquid.
So if I bought one, I couldn't sell it.
If a retail investor somehow bought a corporate bond and suddenly needed to sell it to pay for, say, a medical emergency, they might look at the exchange screen and find absolutely zero buyers at any reasonable price.
The bid-ask spread would just be disastrous.
Disastrous. You take a huge loss just trying to find liquidity.
Okay, so understanding that this is this big institutional wholesale-dominated arena, let's look at the actual instruments these giants are trading. We need to crack the code of fixed returns.
The anatomy of the bond itself.
Exactly, because the very term fixed income implies a rigidity that equities simply do not possess.
Oh, absolutely. An equity share makes absolutely no promises to you. A company is not legally obligated to pay a dividend, and they certainly aren't obligated to return your initial capital.
It is pure risk capital participating in residual profits.
Right. But a bond is a legal straitjacket.
I love that analogy.
It is a forward contract on future cash flows. When an entity issues a bond, they're making two non-negotiable legal promises.
Okay, what's the first?
The first is the periodic payment of interest, which the market calls the coupon.
The coupon, got it.
It is usually expressed as an annualized percentage of the principal, and it's paid out semi-annually or annually.
Okay, and the second promise?
The second promise is the return of the exact principal amount, what we call the face value or par value, on a strictly defined future date.
The maturity date.
Exactly.
The face value is fascinating to me because it is completely divorced from the amount of money actually changing hands in the secondary market.
Yes, that trips up so many people.
Right. Like if a bond has a face value of 1,000 rupees, that is the amount the issuer legally owes you at maturity. Period. It is static, even if the bond is trading for 800 or 1,200 today.
That static nature really defines the instrument class. And if a bond has an original maturity of 10 years, it is classified as a capital market instrument.
But the text makes a critical distinction regarding the life cycle of these instruments. Like, time actually changes their classification.
Yes, the transition to the money market.
Right. Walk me through that.
So a 10-year bond is a long-term capital asset. But 9 years later, when that exact same bond only has 6 months left until its maturity date, its risk profile has fundamentally altered.
Because there's almost no time left for things to go wrong.
Exactly. It is no longer subject to massive long-term interest rate shifts. It is essentially acting as a near-cash equivalent. Therefore, any debt instrument with a remaining maturity of 1 year or less is reclassified. It now trades in the money market.
Oh, that makes total sense. Now, you mentioned the two promises, the periodic coupon and the final principal. But the market always creates exceptions.
Always.
And the source material specifically highlights zero coupon bonds.
A seemingly paradoxical instrument.
Really paradoxical.
Yeah.
Because a zero coupon bond makes absolutely no periodic interest payments.
Zero cash flow during its entire life.
So why would any rational investor park their capital in an instrument for 5 years and receive zero interest along the way? Like, what is the incentive there?
Well, the incentive is built entirely into the purchase price. Zero coupon bonds are issued at a deep, deep discount to their face value.
Okay, let's trace the math on this.
Yeah.
Because I need to see how this actually works.
Sure. Let's suppose the face value is 1,000 rupees and it matures in 5 years.
Okay. 1,000 rupees, 5 years out.
Instead of paying you 50 rupees a year in coupons, the issuer sells you the bond today for, say, 750 rupees.
Okay, so I pay 750 today.
Right. You hold it in total silence for 5 years. No checks, no cash flow. Then, on the maturity date, the issuer hands you the full 1,000 rupees.
I see.
Your entire return, the interest you implicitly earned, is that 250 rupee capital appreciation between your discounted purchase price and the full par value at maturity.
So it just defers the entire tax and cash flow event to the very end of the line.
Exactly.
Okay, but whether it's a zero coupon bond or a standard coupon paying bond, we have to confront what I think is the most unbreakable law in fixed income. The golden rule of bonds.
Oh, yes.
This is the mechanism that I feel confuses more people than anything else, but it is the absolute bedrock of how the market functions.
You are referring to the inverse relationship between market interest rates and bond prices.
Yes. Let's not just state the rule, though.
Well,
Let's force the actual mechanism into the open so it makes intuitive sense to the listener.
Okay. Think of it through the lens of opportunity cost.
Opportunity cost.
Okay. Let's say you participate in a primary issue today. You buy a brand new 10-year government bond with a face value of 1,000 rupees, and it pays a fixed coupon of 6%.
Okay. I pay 1,000, I get 6%.
You are locked in. You will receive 60 rupees every single year for a decade, and you feel good about this.
Yeah, but the macroeconomic environment doesn't stand still.
Never. 6 months later, let's say inflation spikes. The RBI steps in to cool the economy down, and they raise benchmark interest rates aggressively.
Right.
Now, the government needs to issue new 10-year bonds. But to attract capital in this new high-rate environment, they have to offer an 8% coupon.
So brand new bonds hitting the market today are paying 80 rupees a year.
Exactly. Now, put yourself in the position of a portfolio manager who wants to buy government debt today. They look at the primary market and see a shiny new bond offering 8%.
Yeah.
Then they look at you, holding your old bond that only pays 6%. Are they going to pay you 1,000 rupees for your bond?
Absolutely not. Why would they pay full price for my 6% yield when they can get 8% down the street? my bond has instantly become kind of toxic waste at its current price.
Right. So how do you convince them to buy it from you?
I have to lower the price.
Exactly. You have to compensate them for the missing 2% of interest they are giving up every year by buying your bond instead of the new one. And the only way you can do that is by taking a loss on the principal. You have to drop the asking price of your bond.
So I discount it from 1,000 down to, say, 850 rupees.
Exactly. And this is the magic of the math here. If the new buyer pays only 850 rupees to you, but they still get the 60 rupees a year from the government, plus the full 1,000 face value when it matures.
Their total effective return on that 850 rupee investment climbs up to match the prevailing 8% market rate.
That is the core of it. Market rates went up, so your bond's price went down. An ironclad inverse relationship.
And it works in reverse, right?
Yeah, entirely. If the RBI slashed rates to 4%, suddenly your 6% bond is a highly coveted asset. Buyers will bid the price up above the 1,000 rupee face value. They will pay a premium until the effective return is dragged all the way down to the new 4% market reality.
That is so incredibly elegant.
Oh.
So we have established that a bond is a strict legal contract for fixed cash flows, but its day-to-day market price is wildly fluid, acting as a kind of shock absorber for shifting macroeconomic interest rates.
Very well put.
However, as we dive deeper into this PMS workbook, we discover that the fixed nature of the cash flows themselves isn't always a guarantee.
No, it's not.
The legal contract can contain trapdoors.
Yes. The fixed income market actually thrives on optionality. We're talking about embedded options.
Embedded options. Okay.
These are specific clauses written into the indenture, the master legal document, that fundamentally alter the power dynamic between the issuer who owes the money and the investor who lent it.
And just to be clear, we aren't talking about trading options on a derivatives exchange. These options are baked directly into the DNA of the bond itself.
Right. They are inseparable from the bond.
Okay, let's start with the one that gives portfolio managers absolute nightmares, the callable bond.
Oh, yes. A call option embedded in a bond grants the issuer the right, but crucially not the obligation, to redeem the outstanding debt before its scheduled maturity date.
Wait, so they can force you to take your principal back early?
Yes. They can just hand you your money back and cancel the deal.
Why does this even exist? And who does it benefit? Because if I'm an investor who locked in a 10-year timeline, I don't want my money suddenly dumped back into my lap at year 3.
It strictly benefits the issuer, which is typically a corporation trying to optimize its cost of capital. An issuer will exercise a call option when market conditions shift in their favor.
So when interest rates drop,
Specifically, when prevailing interest rates fall significantly below the coupon rate they are currently paying on the bond.
let's walk through the corporate finance logic of this, just to make it concrete.
Sure. Imagine a massive infrastructure conglomerate. 5 years ago, credit was really tight, and they had to issue 10-year bonds at a punishing 9% coupon to fund a new seaport.
Okay, so they're legally bound to pay that 9%.
Right. But today, 5 years later, the macroeconomic environment has softened, liquidity is flush all over the market, and new 10-year corporate debt is pricing at just 5%.
Oh, man. So the CFO of that conglomerate is looking at their balance sheet and just bleeding cash. They are overpaying for their debt by 400 basis points.
Exactly. Now, if the bond is a standard, plain vanilla instrument, they are trapped. They have to suffer that 9% for 5 more years.
Right.
But if they had the foresight to issue a callable bond, the CFO pulls the ripcord.
They just killed the bond.
They announce a call date. They wire the face value of the bonds back to the investors, which legally extinguishes the 9% debt. And then that exact same afternoon, they issue brand new bonds to the market at 5%.
They basically just refinance their corporate mortgage.
Exactly. Brilliant for the company's bottom line.
But let's look at the devastation this causes on the other side of the trade. The investor.
Yeah, the investor gets hit with what is arguably the most insidious danger in fixed income, reinvestment risk.
Reinvestment risk.
Think about the pension fund manager who bought that 9% bond. They modeled all their future liabilities, paying retirees their monthly checks, assuming they had a guaranteed 9% stream of income for a decade.
And suddenly the bond is called. The 9% stream just vanishes.
It vanishes. The fund manager is handed a massive pile of cash, but the prevailing market rate is now only 5%.
Right.
They have to take that cash and reinvest it in a 5% world. Their income just collapsed overnight.
That is brutal. So because the issuer holds all the cards in a callable bond, the market must demand some kind of compensation up front.
Oh, absolutely. A callable bond must generally offer a higher initial coupon rate than an identical non-callable bond, just to entice investors to take on that severe reinvestment risk.
Okay, so a call option is a weapon wielded by the issuer. Is there an embedded option that protects the investor?
Yes, thankfully. That would be the puttable bond.
A put option.
Right. A put option embedded in the indenture gives the bondholder, the investor, the right to sell the bond back to the issuer at a predetermined par value on specific dates before maturity.
It is basically an escape hatch.
A highly, highly valuable one. An investor will exercise this put option when the macroeconomic environment turns against them, specifically when interest rates rise.
Okay, let's run the scenario on this one. I buy a 10-year corporate bond at a 5% coupon. 3 years later, inflation runs hot, and the market rates jump to 8%.
Okay.
As we know from the golden rule, the secondary market price of my 5% bond is going to absolutely plummet.
Right. It's trading at a deep discount now.
So if I need to sell it to raise cash, I
Ah.
will take a massive capital loss.
Unless you have a put option.
Ah.
If it is a puttable bond, you just ignore the bleeding secondary market. You simply notify the issuer, exercise the put, and legally force the corporation to buy the bond back from you at full face value.
Wow. So I take my principal, completely intact, and I immediately reinvest it in the new 8% bonds.
Exactly. You essentially force the corporation to absorb the interest rate risk instead of you taking the hit.
Which means puttable bonds must be expensive.
Very. Because you are buying this incredible downside protection, you pay for it in the form of a lower yield. A puttable bond will always have a lower initial coupon than a standard plain vanilla bond.
There is no free lunch in this market. You either take the risk and get a higher yield with a callable bond, or you pay for safety and accept a lower yield with a puttable bond.
That's the trade-off.
But the source material introduces a third variant that really blurs the line between the fixed income control room and the equity casino.
The convertible bond.
The convertible bond.
It is a fascinating piece of financial engineering. It is a true hybrid security. At its core, it starts its life as a standard corporate bond. It pays a regular coupon, it has a face value, and it sits higher up in the capital structure than equity in the event of bankruptcy.
This debt.
It is debt, but it contains an embedded call option on the company's equity.
Wait, what does that mean practically?
It grants the bondholder the right, under highly specific conditions, to surrender the bond and exchange it for a predetermined number of common shares in the issuing company.
Wait, so I start as a lender, safely collecting my little interest checks. But if I watch the company launch, I don't know, a revolutionary new product, and their stock price goes vertical,
Yeah.
I could just push a button, basically destroy my bond, and instantly become a shareholder to ride the rocket ship up.
That's exactly it. It is the holy grail of asymmetry, theoretically.
Oh.
Because you have the downside protection of a fixed income instrument. If the company stagnates, the stock price goes nowhere, you simply hold the bond to maturity, collect your coupons, and get your principal back.
Right.
But if the company becomes the next tech unicorn, your bond's value detaches from the math of interest rates and becomes mathematically pegged to the surging stock price.
But again, no free lunch. What is the catch here?
The catch is severe yield sacrifice. Companies know they are basically giving you a lottery ticket attached to a bond.
Right.
Therefore, convertible bonds offer significantly lower coupon rates than plain vanilla debt from the exact same issuer. You are funding their growth at a very cheap rate in exchange for the option to participate in the massive upside later.
So we have built a profound understanding of the mechanics so far. We have the rigid promises of coupons and par values. We have the dynamic pricing of the secondary market dictated by macro rates. We have the asymmetrical warfare of embedded call and put options.
Yeah.
But all of this intricate financial architecture rests on one terrifyingly simple premise.
That the check actually clears.
That the issuer doesn't go broke. The illusion of safety. How do institutional investors, mutual funds, and PMS managers evaluate the existential threat that the money simply won't be there at maturity?
This brings us to credit risk and the legal fortifications of covenants.
Right. Let's get into segment 4, credit risk.
Credit risk, or default risk, is sort of the dark matter of the fixed income universe. Interest rate risk, which we discussed with the golden rule, only affects the price of your bond if you sell it early.
Right. If I hold it to maturity, I get my 1,000 rupees.
Exactly. If you hold it to maturity, you don't really care about interest rate fluctuations. But credit risk is absolute. If a company defaults, your principal vanishes.
So when a massive institution is lending 500 crores to a corporation, they obviously do not rely on a handshake and a promise. They rely on the indenture.
The indenture. It is the foundational legal contract of the bond.
What does it actually look like?
Oh, it is hundreds of pages long. It dictates every mathematical feature we've discussed so far, but its most critical function is establishing the covenants.
The covenants.
These are the legally binding rules of behavior that the issuer must strictly adhere to while the debt is outstanding.
The text splits these into positive and negative covenants. Let's look at the affirmative duties first. Positive covenants, what are they making the company do?
Positive covenants are actions the issuer is legally forced to perform just to maintain the basic health of the company.
Like what?
It might dictate that the corporation must maintain a minimum current ratio, meaning their short-term assets must always exceed their short-term liabilities.
Keep cash on hand, basically.
Right. It might force them to keep all physical manufacturing plants fully insured against disaster. It always mandates the delivery of audited quarterly financial statements to the bond trustee.
So it forces transparency and basic corporate hygiene.
Exactly.
But the real teeth of the indenture, the clauses that portfolio managers scrutinize with a microscope, are the negative covenants.
Oh, absolutely. Negative covenants are strict prohibitions. They act as financial straitjackets to prevent corporate management from taking reckless actions that could jeopardize the bondholders' capital.
Give me the scenarios here. What are they stopping the CEO from doing?
A classic negative covenant restricts the issuance of additional debt. If you lend a company 100 crores, you don't want them turning around tomorrow and borrowing another 1,000 crores from someone else.
Because now the company's cash flow is stretched dangerously thin, which increases my risk of default.
Exactly. They protect their place in line.
That makes sense. What else?
They also restrict asset sales. A negative covenant might prevent a conglomerate from selling off its most profitable subsidiary just to fund some risky new venture.
Right.
Or, crucially, it might restrict dividend payments to equity shareholders.
Oh, that's a massive one.
Think about it from the bondholder's perspective. If a company is struggling to make its coupon payments to you, you do not want the CEO suddenly deciding to pay out a massive special dividend to the stock owners.
Because they're draining the very cash reserves needed to service the debt.
Precisely. The negative covenant legally traps the cash inside the firm for the explicit benefit of the bondholders.
So the covenants dictate behavior. But if the worst happens and the company still spirals toward bankruptcy despite the rules, the next layer of defense is the collateral backing the bond.
Right. We have to look at secured versus unsecured debt.
This determines your recovery rate in a disaster.
Yes. Secured bonds are backed by a very specific legal claim on identifiable assets.
For example.
A utility company issues a bond secured by a brand new power plant. Or an airline issues what are called equipment trust certificates, which are secured by a specific fleet of Airbus planes.
Okay, so if the airline goes bankrupt,
The bondholders foreclose. They legally seize the planes, sell them in the open market, and use those proceeds to make themselves whole.
contrast that with an unsecured bond.
Unsecured bonds, often referred to as naked debentures in the market, have absolutely no specific assets pledged against them.
So what are they backed by?
They are backed entirely by the general creditworthiness, the future cash flows, and the overall reputation of the issuing corporation.
Okay, so if that company goes under, unsecured bondholders have no planes to seize, no power plants.
Nothing. They are thrown into the massive general pool of unsecured creditors in bankruptcy court, and they end up fighting over whatever scraps of cash are left after the secured creditors, the tax authorities, and the employees have all been paid.
Which is why unsecured debt must always offer a higher yield than secured debt from the exact same company. The risk premium is just inherently elevated.
That's exactly right.
Now, a portfolio manager cannot personally audit the collateral and the cash flows of every single company in the market. I mean, it's impossible.
Totally impossible.
So the ecosystem requires an independent arbiter of risk. And this is the role of credit rating agencies. CRISIL, ICRI, CARE in India, or S&P and Moody's globally.
Yes. These agencies perform exhaustive forensic accounting on issuers and assign a standardized alphanumeric rating that indicates the statistical probability of default.
Let's walk through the scale provided in the text,
Yeah.
because this alphabet soup dictates literally trillions of dollars of institutional capital flows.
Okay, for long-term debt maturities over 1 year, the scale is universally recognized. At the absolute pinnacle, you have AAA.
AAA, the gold standard.
The gold standard. AAA indicates the highest degree of safety regarding the timely servicing of financial obligations. The probability of default is infinitesimally small.
Like who gets AAA?
These are usually sovereign governments or massive, globally dominant corporations with completely bulletproof balance sheets.
Okay.
As you move down the scale, A, B, 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 the risk incrementally increases, and therefore the market demands a correspondingly higher yield.
But there is a massive fault line in this scale, isn't there? A border wall that changes the entire nature of the investment,
Yes, the dividing line between investment grade and speculative grade.
which people usually call high yield or junk bonds.
Exactly.
Where exactly is the border?
The border sits at BBB. Anything rated BBB or higher is considered investment grade. And this is incredibly crucial because many massive institutional pools of capital like pension funds or very conservative mutual funds have strict legal mandates written into their charters that legally prohibit them from buying anything below investment grade.
Wow, so if a bond gets downgraded to BB, it drops off a cliff.
It falls entirely into speculative territory. The institutional buyers just vanish. They legally have to sell it.
So who buys it?
The only buyers left are specialized high-yield funds or distressed debt hedge funds. And because the buyer pool is so much smaller and the risk is significantly higher, a company issuing BB debt must pay a drastically higher coupon rate to attract any capital.
And if you continue down the alphabet?
If you get to C, you are looking at imminent default. And D means the issuer has actually missed a payment. They are currently in default.
The text also mentions a different scale for the money market, the short-term instruments under 1 year.
Yes, short-term ratings focus purely on immediate liquidity. Will the company survive the next 6 months? This scale typically runs from A1 down to A4. A1 is the highest safety, A4 is highly speculative short-term debt, and again, D is default.
Okay, I want to highlight a massive trap that novice investors fall into when looking at these ratings. The text makes it explicitly clear. A credit rating is assigned to the specific instrument, not the firm.
Yes. You are hitting on a crucial vulnerability in casual analysis. You absolutely cannot simply say, I am buying debt from Tata Motors. Tata is a massive blue chip conglomerate, therefore my investment is AAA safe.
Let's invent a scenario to prove why that lazy thinking is lethal.
Perfect. Imagine a massive telecom conglomerate. They have a pristine reputation. They issue a secured bond to build out their 5G network.
Okay.
The bond is strictly secured by the physical spectrum licenses, which are incredibly valuable assets. The rating agency analyzes that specific indenture, sees the bulletproof collateral, and assigns the instrument a AAA rating.
The safest of the safe.
But a year later, the holding company of that exact same telecom conglomerate needs cash to fund a highly speculative acquisition in a foreign country.
Oh.
So they issue an unsecured bond. It has no collateral. It is deeply subordinated, meaning in bankruptcy, it gets paid last.
But it has the same corporate logo on the building.
Same logo, but a radically different legal position. The rating agency looks at that unsecured, subordinated indenture and says, if this wild acquisition fails, these bondholders are getting completely wiped out. They assign that specific instrument a BB rating, junk status.
So one company can have AAA investment-grade debt and BB junk debt trading in the market at the exact same moment.
Exactly. You are investing in the brand. You are investing in your specific place in the legal waterfall of the contract.
Which brings us to the mathematical crux of the entire endeavor. Once you have read the indenture, assessed the credit risk, and understand the macro environment, you have to decide what the bond is actually worth today.
Right. We are transitioning from qualitative legal analysis to quantitative mathematical valuation.
Segment 5. Finding the true value. Yields, prices, and the Excel engines that run the market.
When you look at a bond trading on an exchange, you see a quoted price. Let's call it 104 rupees for a bond with 100 rupee face value.
Okay.
That is the market price. It tells you what someone is willing to pay right this second. But a rigorous portfolio manager doesn't really care about the market price until they have calculated the intrinsic value.
Intrinsic value. That's the philosophical truth of the asset, right? What is it actually worth based on its future cash flows?
Precisely. And in fixed income, we find that truth using discounted cash flow or DCF analysis.
The Holy Grail. Walk us through the philosophy of the DCF engine, because it's heavy.
It is, but it rests entirely on a simple concept. The time value of money.
Okay.
1,000 rupees handed to you today is inherently more valuable than 1,000 rupees promised to you 5 years from now.
Because if I have it today, I can invest it at the risk-free rate and earn interest for 5 years.
Exactly. So future cash flows are essentially a depreciating asset the further out in time they go.
Okay, so how do we apply that to the bond?
To find the intrinsic value of a bond today, you must map out every single future cash flow. every semi-annual coupon payment, and that massive principal repayment at maturity.
Got my map.
Then you choose a discount rate. This rate represents your required rate of return based on the bond's credit risk and the current macro environment.
Okay, so I take that discount rate and I basically apply it backwards.
Yes. You systematically shrink every single future cash flow. A 50 rupee coupon paid in year 1 might be worth, say, 47 rupees in present value terms.
Right.
The 1,000 rupee principal paid in year 10 might only be worth 600 rupees in present value. You shrink them all individually based on how far in the future they are, and then you sum up all those present values.
And that final aggregated number is the intrinsic value.
Yes.
And then you compare it to the screen. If your DCF model says the intrinsic value is 1,050 rupees, but the market price on the screen is only 1,000 rupees.
You back up the truck and buy it.
Right.
The bond is mathematically undervalued. You have found an arbitrage opportunity between your rigorous model and the current market sentiment.
Now, calculating DCF by hand across 40 different cash flows involves massive polynomial equations. But the text mercifully notes that modern finance relies entirely on software for this.
Thankfully, the standard tool is just the Excel price function. A portfolio manager simply inputs the settlement date, maturity date, the annual coupon rate, and their required discount yield.
And the algorithm instantly runs the present value summation and spits out the intrinsic price.
In a millisecond.
Okay, so that calculates a price based on a desired yield. But what if I am looking at the market price and I want to know exactly what annualized return I will get if I buy it at that sticker price?
Then you are calculating the single most famous metric in all of fixed income, the yield to maturity, or YTM.
YTM. It is the great equalizer, isn't it? It allows you to compare a 5-year zero-coupon bond trading at a massive discount against a 10-year high-coupon bond trading at a premium.
Exactly. YTM is defined as the internal rate of return of a bond if the investor purchases it at the current market price and holds it strictly until the maturity date.
So it blends everything together.
Yes. It is a single, annualized percentage that perfectly blends the coupon income with any capital gain or loss realized from buying the bond away from its par value.
And again, the text points to the Excel yield function.
Yeah.
You plug in the market price, and it reverses the DCF math to find the internal rate of return.
Right.
But we don't always need a spreadsheet to understand the relationship between YTM and the coupon. There is a strict, undeniable mathematical framework here.
Think back to the golden rule we discussed earlier. The relationship between a bond's trading status, whether it's at a discount, a premium, or par strictly dictates how its YTM relates to its printed coupon rate.
Let's establish these rules of thumb.
Scenario 1. A bond is selling at a discount, meaning the market price is lower than the face value. Say you pay 900 rupees for a 1,000 rupee bond paying a 5% coupon. In this scenario, the YTM will always be strictly greater than the 5% coupon rate.
Let me make sure I get why. It's because my return isn't just the 50 rupees a year in coupons. My return is the 50 rupees plus the guaranteed capital gain of 100 rupees when the bond matures and pays me the full 1,000.
Exactly. Your total yield is turbocharged above the coupon by that capital gain.
Okay, scenario 2.
Scenario 2. A bond is selling at a premium. You pay 1,100 rupees for that same 1,000 rupee bond because it pays a massive 10% coupon.
Right.
The YTM will always be strictly less than the 10% coupon rate.
Because I am basically suffering a slow, agonizing capital loss. I mean, I am getting big 100 rupee interest checks every year, but I know that at the end of the timeline, I'm going to lose 100 rupees of principal because the issuer is only giving me 1,000 back.
Correct. That built-in capital loss drags your total effective yield down below 10%.
In scenario 3.
Scenario 3. A bond is selling exactly at par. You pay 1,000 rupees for a 1,000 rupee face value. In this perfectly balanced state, the YTM exactly equals the coupon rate.
It is such an elegant, closed-loop mathematical system. But just when you think you have fixed income completely figured out, you encounter the gritty, real-world mechanics of how trades actually settle.
Oh, yes. The friction of reality.
The source material highlights a bizarre quirk that dictates how billions of rupees change hands. Day count conventions.
This is where the pristine math meets the very messy reality of the calendar.
Set up the problem for us here.
Well, most bonds pay interest semi-annually. Every 6 months, a check goes out. But the secondary market trades every single day.
Right.
If you buy a bond from me exactly 3 months after the last coupon payment, Who gets the next check?
Well, the issuer doesn't care who held it when. They just send the full 6-month check to whoever holds the bond on the record date,
Exactly.
which means I, the new buyer, will get a check for 6 months of interest, even though I've only owned it for 3 months.
Which is fundamentally unfair to the seller.
Yeah.
I held the bond for 3 months. I earn half of that interest.
So the market mechanism fixes this with accrued interest.
Right. When you buy the bond from me, you pay me the agreed-upon market price of the bond, what we call the clean price. Plus, you have to pay me out of your own pocket for the 3 months of interest I accrued.
And that combined total is called the dirty price.
Yeah.
It's the actual cash that changes hands between us.
Yes. But here is the critical question. How exactly do we calculate what 3 months of interest actually is? How do we count the days?
I mean, you look at a calendar, you count the actual days in October, the days in November.
You would think so. But the Indian corporate and government bond market uses a day count convention known as 3360.
3D360. Break that down for me.
It is an entirely artificial standardized reality. To calculate accrued interest, the 3360 convention mandates that every single month has exactly 30 days, and it mandates that the year has exactly 360 days.
Wait, hold on. So in the eyes of a bond trader calculating a multi-million rupee settlement, February has 30 days.
Yes.
And October has 30 days.
Yes.
Why on earth would an advanced trillion-dollar financial system use a fake calendar?
It is a hilarious vestige of the pre-computer era. Before algorithmic trading and instant settlement software, clearing houses had to calculate accrued interest manually on millions of trades.
Wow.
Dealing with leap years, 31-day months, and 28-day Februaries was a mathematical nightmare that caused endless settlement errors. Standardizing every month to 30 days made the manual fractions perfectly smooth and easy to calculate on paper.
And the market just never bothered to update the system once computers arrived.
Basically, no. But the text makes a very specific point of contrasting this with the money market.
Right. The money market dealing with T-bills and commercial paper under 1 year operates on a different standard. They use the actual 365 convention.
Which means they use the real calendar. They count the literal, actual days between trades and divide by 365.
And this might sound like arcane trivia to a casual listener, but consider the scale. If you are executing a block trade of 10,000 crores of government securities, the difference between calculating accrued interest using a 360-day year versus a 365-day year equates to millions of rupees of real cash either gained or lost in the settlement.
Millions. A portfolio manager must know exactly which calendar their instrument lives in.
Okay, so we have built the DCF models, we understand YTM, and we know how to calculate the exact dirty price using fake calendars. But everything we have discussed so far is completely static.
Yes, we are valuing the bond today.
We need to transition to the most dynamic, frankly aggressive part of the syllabus, riding the roller coaster.
We must confront price volatility.
Because we know from the golden rule that when market rates change, bond prices move inversely. But as a risk manager, knowing the direction isn't enough. You need to know the magnitude. How violently will the price swing?
Exactly. If the central bank hikes rates by 1% tomorrow, will your bond drop by 2% or will it crash by 15%?
Right. And the text identifies 4 structural factors inherent in the bond that dictate its volatility: the par value, the coupon rate, the maturity period, and the prevailing market interest rate.
Let's isolate the 2 factors that portfolio managers actively select to control their risk: the coupon effect and the maturity effect.
Let's start with the coupon. What is the rule?
Holding all else equal, a bond with a lower coupon rate will be more volatile in price than a bond with a higher coupon rate.
Okay, I want to really dig into the why here. If I hold a massive 12% coupon bond and you hold a tiny 2% coupon bond and rates suddenly change, why is your bond whipping around wildly while mine is relatively stable?
It all comes back to the DCF model and the time value of money. With your 12% bond, the issuer is returning a massive chunk of your capital to you very quickly in the form of those huge early interest checks.
Okay.
Your cash flows are heavily front-loaded. Because you get your money back faster, you are far less exposed to what happens to interest rates 10 years from now.
So my risk is mitigated by early cash recovery.
Exactly. But look at my 2% bond. The annual payments are a mere trickle. The vast, overwhelming majority of my total return is locked up in that final 1,000 rupee principal repayment at the very end of the timeline.
And because that massive cash flow is sitting a decade in the future, it is hypersensitive to the discount rate.
Hypersensitive. A tiny change in the discount rate compounds over 10 years to drastically alter the present value of that final payment.
Which means the most volatile, hypersensitive instrument in the entire fixed income universe would be?
The zero coupon bond.
Because it has zero early cash flow. 100% of its value is anchored at the extreme end of the timeline. Therefore, it absorbs the absolute maximum impact of compounding discount rate changes.
You're hitting on the crucial vulnerability perfectly. Now let's look at the maturity effect.
The rule here feels pretty intuitive. Longer maturity bonds are more volatile than shorter maturity bonds. A 30-year bond will experience much more violent price swings than a 2-year bond.
It is intuitive because the discount rate has a longer timeline to compound its effect. However, the text highlights a nuanced mathematical reality about this volatility. It actually increases at a diminishing rate.
A diminishing rate. Explain the curve to me.
Okay. Moving your capital from a 2-year bond to a 10-year bond massively increases your volatility. You are adding 8 full years of compounding discount risk.
Right.
But moving from a 20-year bond to a 30-year bond, even though you're adding a full 10 years, only increases the volatility slightly.
Like, why does the curve flatten out like that?
Because of the absolute brutality of present value discounting. By the time you get to year 20, the present value of a cash flow has already been shrunk to a tiny fraction of its future size.
Oh.
Pushing it out to year 30 shrinks it a bit more, but mathematically there just isn't much value left to destroy. The leverage the discount rate has over the price basically diminishes at the extreme long end of the curve.
That is fascinating.
Okay.
Now let's introduce a concept that feels like an absolute cheat code for bondholders. The asymmetry rule, or convexity.
Oh, convexity.
We know the relationship between price and yield is inverse. But the text notes it is not a perfect mirror image.
No, it is not a straight line. It is a convex curve. Here is the asymmetrical reality. A specific decrease in market yields will drive a bond's price up more than an identical increase in yields will drive the price down.
Let me visualize this to make sure I have it. If the RBI drops interest rates by 1%, my bond price might rocket up by, say, 12%. But if the RBI hikes rates by 1%, my bond price will only fall by 9%.
That is exactly the dynamic.
Why? Why do I get more upside than downside?
Think about the math boundaries. The price of a bond can theoretically rise to infinity as yields approach absolute zero.
Right.
But the price of a bond cannot mathematically drop below zero no matter how astronomically high yields go. Because the downside has a hard mathematical floor at zero, the DCF math intrinsically bows outward. It creates a cushion on the way down and an accelerator on the way up.
Portfolio managers must love convexity.
They obsess over it.
Okay, we've mentioned YTM several times as the ultimate yardstick. But when dealing with volatility over time, we really have to expose the massive, often fatal flaw in the YTM assumption, reinvestment rate risk.
Yes, YTM is a beautiful single metric, but it is a theoretical fiction.
Not fiction.
It implicitly assumes that every single time you receive a semi-annual coupon check, you are immediately reinvesting that cash back into the market at the exact same rate as the original YTM.
Which is practically impossible in the real world.
Impossible. Imagine you lock in a brilliant 10% YTM on a 20-year bond. You model your entire retirement assuming a 10% compounding return.
Oh.
But 3 years later, a global recession hits and central banks slash rates to 2%.
Well, my bond price skyrockets. I feel like a genius.
On paper, yes. But then your first coupon check arrives. You take that cash and you go to the market to reinvest it, but the market only offers 2%. Your interest on interest compounding is completely destroyed. You will never achieve the original 10% YPM because you cannot reinvest your intermediate cash flows at 10%.
The paradox of dropping rates. Your capital gains look great today, but your reinvested income just starves in the future.
Exactly.
So a portfolio manager knows all these moving parts, maturity, coupon, convexity, reinvestment risk, but they can't manage a billion-dollar portfolio based on rules of thumb. They need a hard, exact number that quantifies their total risk.
They need duration.
Duration.
This is the apex of fixed income mathematics. But we must be very careful to distinguish between the two types mentioned in the workbook, Macaulay duration and modified duration.
Let's tackle Macaulay duration first, named after Frederick Macaulay in 1938.
Right. Macaulay duration measures time. It does not measure price swings. It is defined as the weighted average time it takes for an investor to recover their initial investment in the bond, expressed in years.
So if I buy a 10-year bond, the Macaulay duration is not 10.
No, because you are receiving those semi-annual coupon payments. You are recouping fractions of your initial investment in year 1, year 2, year 3. Macaulay duration calculates the center of gravity of all those cash flows.
The center of gravity. I like that.
For a standard 10-year coupon-paying bond, the Macaulay duration might be, say, 7.2 years. That 7.2 is the true weighted timeline of your risk exposure.
And the only scenario where Macaulay duration exactly equals the maturity date.
The zero coupon bond. Because there are no interim cash flows pulling the center of gravity forward, you recover 100% of your investment on the final day. A 10-year zero coupon bond has a Macaulay duration of exactly 10 years.
Okay, so Macaulay gives me a sophisticated time frame. But if I am a risk manager on a trading floor, I don't just want to know my weighted time exposure. I
Right.
want to know exactly how much blood I will lose if the central bank hikes rates tomorrow morning.
And for that, you take the Macaulay time value and you run it through a mathematical adjustment to find modified duration.
Modified duration.
Modified duration is the first derivative of the price yield curve. It is a direct, precise measure of price sensitivity.
Give me the formula that actually rules the trading floor.
The approximate percentage change in the price of a bond is equal to the negative modified duration multiplied by the change in market interest rates.
Percentage change in price equals negative modified duration times the yield change. Let's run a live scenario.
Okay.
I'm managing a 500 crore fixed income fund. My quantitative analysts tell me the weighted modified duration of my entire portfolio is 6.5.
All right.
We're sitting at our terminals and news breaks. Inflation is completely out of control and market yields instantly spike by 2%.
You plug it right into the algorithm. Negative 6.5 multiplied by positive 2%. The result is negative 13%.
My 500 crore portfolio just lost 13% of its market value in a fraction of a second. I lost 65 crores.
You know the exact damage instantly. And this metric is exactly why the fixed income market functions at an institutional level. It allows managers to actively hedge. If you are terrified that rates are going up next month, you don't have to sell everything. You can strategically restructure the portfolio, sell long-duration bonds, buy short-duration T-bills, and lower the portfolio's overall modified duration from 6.5 down to 2.0.
You literally dial down the risk. You insulate your capital.
You control the lever.
Wow. We have covered an extraordinary amount of terrain today, diving deep into Chapter 4 of the PMS workbook. We didn't just look at the surface, we really mapped the architecture.
We covered a lot of ground.
We explored the vast invisible Indian wholesale market, dominated by the RBI and SEBI. We broke down the ironclad math of the golden rule, where prices must flex to accommodate shifting macro rates.
We analyzed the asymmetrical warfare of embedded options, how callable bonds transfer reinvestment risk to the investor, while puttable bonds provide that crucial escape hatch.
Right. And we mapped the legal fortifications of covenants and the strict hierarchies of secured versus unsecured credit risk.
And finally, we decoded the quantitative engines that run the trading floors. The discounted cash flow models finding intrinsic value, the massive real-world implications of the 3360-day count convention, and the ultimate risk cheat code, modified duration.
It is a market that demands rigorous analysis, but it absolutely rewards precision.
It really does.
Before we wrap up, I want to leave you, the listener, with a final, provocative thought experiment, a way to pressure test everything you've learned today. Think about the entire quantitative edifice we just described.
Math.
Yeah. A lot of TM, Macaulay duration, convexity. Every single one of these formulas relies on a foundational philosophical assumption: predictability. They assume the discount rate might move slowly, predictably, giving you time to calculate and adjust.
The math practically requires the macroeconomic environment to act within a defined standard deviation.
Exactly. So what happens if we enter an era of unprecedented, violent macroeconomic shocks? An era where supply chains fracture, inflation swings wildly from 2% to 10% back to zero, and central banks are forced into panic hiking and panic slashing month after month.
In that kind of environment, the discount rate becomes a completely chaotic variable.
Right. And if the discount rate is violently unpredictable, the present value of a cash flow 10 years from now becomes mathematically impossible to determine with any confidence. Does a metric like modified duration actually become worse than useless?
It might.
Does it give a portfolio manager a false sense of security while the very foundations of the price yield curve are shifting? In a world of extreme macro chaos, do these supposedly fixed income securities effectively become just as speculative, just as volatile, and just as dangerous as the most speculative equities?
Scary thought.
Something to really think about the next time you look at a supposedly safe bond portfolio, or the next time someone tells you to move your capital into fixed income to avoid volatility. Because as we've seen today, the bond market isn't a quiet harbor. It's the engine room of global finance, and sometimes the engine runs incredibly hot. Thanks for diving deep with us.